All right, yield nerds, we've come this far, and I think there is a very exciting journey ahead with what I would hope are interesting observations for you. Frankly, when I put it all together, how corporate bonds fit in and where they fit in after their tax implications was educational for me as well. Okay, before we get deeper, we're going to start recapping what the yield curve is so you will have that context. We're going to look at what today's corporate bond rates are across the various, credit worthiness, the AAA, the AA, and the single A. And then we're going to start putting them all together, meaning put treasuries, agencies, munis, and add corporates into the mix on a tax adjusted basis and see what happens. And then we'll buy a bond. All right. The yield curve, for those who may have forgotten, is the simple concept that if you want me to loan you $100 for your tomato farm, and you tell me that you will give me $2 every quarter for the next year or 2 years, that's plan A. And then you tell me, well, now you want to give me the $100 back after 10 years instead of 2 years. I rightfully would say, wait a second, that's a much longer duration. I need a bigger coupon payment. Maybe I want 250 instead of 2, and so on and so forth. And we saw that in the case of the Treasury, there is actually what is called an inversion, meaning at the end of 1 year, you actually have a lower coupon for more duration. And we saw that this generally appears to be the case right in before a recession. And if any of this sounds too new to you or not exactly fresh in your mind, I would encourage you to go back and watch the episode on treasuries. Okay, now let us start diving deeper. You may remember treasuries are state and local tax exempt. And what does that do to our world? We reviewed in this episode, we reviewed what are corporate bonds, why do we need them, how can you research them, how can you look at their prospectus. When you start plotting the interest rates and the yield to maturity available for corporate bonds over the durations available, you kind of see that it slopes linearly upwards, which is what you would expect. There is no inversion generally. Where there is a steep drop off, it really is because there wasn't a good qualifying bond with that period. But aside from that, in general, the corporate bond yield to maturity goes straight up. There are three lines here because there are three different credit ratings. The line at the bottom, called the AAA, is the highest credit quality. And because they have a high credit quality, their yield to maturity tends to be lower. And naturally, somebody with a lower credit quality or the single A has to pay a higher yield to maturity, as you would only imagine. And so those are the three lines. There is not much inversion. There are durations where you may not have a good bond in one of the credit ratings, but in general, an upward sloping curve makes a lot of sense. So in isolation, corporate bonds look kind of sort of like munis in that as duration increases, then you get a greater yield to maturity. Now we need to introduce the concept of taxes and see what happens. So let's do that. A quick recap of tax treatments of each of the income producing assets. You may remember that treasuries are state and local tax exempt. Some munis are federal tax exempt, and you need to go watch the unit on munis to understand which ones aren't and how they are denoted. And some munis are also state and local tax exempt, except in certain states, that is never the case. Again, please watch the Muni unit if that is not clear to you. And so what we ended up doing is fixing all of those, meaning we would bump up the taxes to make them equivalent. And when it came to federal taxes, again, you may remember the previous episode where we discussed that your federal tax is laddered. Your first dollar is taxed at a much lower rate than your last dollar, and you therefore get a blended tax rate. And I took a position that I think, in terms of my life, not as the first dollar and the last dollar. I always look at the blended rate as my decision making parameter when I evaluate muni bonds, and you should do what you want to do. As I said, this is education only. And there is a simple reason that I argued in the previous episode why I use the blended rate, and not the last dollar when looking at a municipal bond. The common argument when looking at a municipal bond is that, hey, a municipal bond pays X%, your last dollar is taxed at whatever percentage, bump up the muni yield by that percentage, and that is the tax equivalent yield. Kumbaya, we should buy more muni bonds because the tax adjusted yield is higher. My humble opinion on that is when I stand at the grocery store line and I pay $49.60 for groceries, I have no clue whether it is the first dollar or the last dollar. To me, it's the same dollar. So my humble opinion is that my average tax rate is what I use as a qualification when I evaluate muni bonds. And the reason that is very important is when we construct the tax adjusted curves. And before I continue on, I want to kind of reiterate, I am not a tax advisor. I'm not a wealth management advisor. I'm educating you. The decisions are yours. Having said that, if your blended tax rate were 20% and you were to bump up your muni bond yields by 20%, because you would say the bond pays 2%, my federal tax, federal income tax rate is 20%. Therefore, getting 2% on a federal tax exempt basis is really like getting 2.4% on a tax exempt basis. And that would be the argument you would make. And you would then compare treasuries, agencies, and munis on a tax adjusted basis. What we saw is that if your federal income tax was 20%, in the short term, Treasuries still handily beat agencies and munis. In the medium term, agencies still beat Treasuries and munis, and it's only in the 20-year plus duration that muni yields compensate, and on a tax adjusted basis, you are better off owning a muni at a 20% federal income tax rate. Now, if your federal income tax rate is 28%, mind you, I keep using federal income tax rate as the blended federal income tax rate, not the last dollar. If your blended tax rate is 28%, what we saw is that because munis are federally tax exempt, munis look a little better. Even so, in the short run, treasuries absolutely win. Agencies win in the medium term. And when you start looking at 5 years and above, munis have the edge because on a tax adjusted basis, bumping their yields up by 28%, munis give you a net advantage by owning them. And that is at 28% blended tax. But if you had a 15% blended tax, at this point, treasuries and agencies pretty much own your yield curve, and munis are so far out in duration that you may not really have the best bang for the buck for owning munis at all. Notice we have not discussed corporate bonds, and there is a reason why, because we are going to very quickly recap everything we have reviewed so far and have it fresh in your mind before we insert the new player, which is corporate bonds. So to be clear, munis worked very well at a high blended tax rate, and a lower tax rate munis did not really have an advantage. Corporate bonds are both federally, state, and locally taxed when it comes to their income and capital gains. And so then we say, what happens when we throw corporate bonds into the mix? We played a yield Super Bowl game earlier when we compared munis with treasuries and agencies. We should, in that same vein, say, now we have a new team. We have the AFC and the NFC. And in the NFC, we now have the new team called the corporate bond boardrooms. The boardrooms, or this fictitious team, represents the corporate bonds and their yield to maturity. And we are going to stack them up on a tax-adjusted basis and start comparing them with the treasuries, agencies, and corporate bonds in one conference. In the other conference, we're going to compare treasuries, agencies, and munis and see who wins, and then have the Super Bowl between the winners of both of them in each class of duration. So here you go. In the NFC, treasuries still beat out corporate bonds in the short duration. In the medium duration, agencies still beat corporate bonds. In the long duration, Houston, we have some very interesting news. The single A corporate bonds on a tax-adjusted basis pay a high enough yield that they outpace treasuries and agencies past a duration of 5 years. How interesting. So then we ask the question, gee, I wonder what's happening in the AFC. And you may remember we are going to give Munis the highest advantage. When your blended tax rate is 28%, you may remember Munis had the best of the best outcome. To recap that again, at a 28% federal income tax, Treasury still won the short duration, agency still won the medium duration, but Munis ruled after 5 years because of the high federal income tax paid by this case study. Then here is my question. If your federal income tax was 28%, there is no question that in durations that are lower, medium durations, agencies win. In the long duration, who do you think wins? Is it the AFC champ, aka the town hall, which is the municipal bond, or is it the NFC champ in long durations, which is the boardroom? That is what we're going to try and figure out. If you want to take a guess, go ahead, try and have your own guess at a 28% blended federal income tax rate, which gives the best of the best advantage to municipal bonds. In long duration, what do you think is going to happen? And here comes the answer. In the short duration, treasuries again win. In the medium duration, agencies again win. Drum roll. Even at the highest tax advantage, Munis only win at the very, very long tail. Corporate bonds in today's interest rate environment trump Munis all the way until 30 years. Now, that is not to say this would change tomorrow or the day after. There are other considerations as well, and we'll talk about some of those. What this is telling you is the premium paid by Muni bonds on a tax-adjusted basis is still less than the premium paid by corporate bonds, and that is why corporate bonds continue to dominate in the yield curve on a tax-adjusted basis. Couple of observations in summary. If your duration is 9 months, a year or less, hands down, treasuries beat everything we have talked about. If it is a medium duration, less than 5 years, agencies win. If your federal tax bracket is less than 20%, munis are not a good deal for you anyway. If your tax bracket is around 28%, corporate bonds and not munis in today's interest rate environment and today's yield environment, they seem to beat munis all the way until a duration of 30 years. We are ignoring a couple of things that you absolutely should also take into account, especially as duration increases. Let's say you're looking at a 30-year bond for an A-rated company. The odds of that company hanging around for 30 years and paying you that yield is definitely lower compared to municipality A or municipality B lasting 30 years. That is something you need to think about. So at the end of the day, know your duration, look at your personal yield curve for your tax bracket, and make a smart decision. That is our message for the day. Okay, we talked about knowing your duration and then making the correct decision based on your tax bracket and your personal yield curve. If you need the worksheet that I use to create my personal yield curve, my scenarios at 15 and 20 and 28, and you want to plug in your own numbers there to get your personal yield curve, shoot me an email and we will make sure you have that information again on an educational basis. Okay, now that we have talked about what corporate bonds are, the yield curve, and so on, let's go on to buy a bond. It's pretty simple, at least on Schwab. My standard disclaimers apply. I'm not endorsing them. You would go to research, you would go to bonds and fixed income. You come to this screen that we have seen several times in Yield Nerd by now, and corporate bonds are located right around the middle of the screen. We're just going to pick off a couple of these. And based on some yield curve work we did before, we're just going to pick the 10-year mark as an example and click on the corporates. And you see a screen like this. To understand the screen, let's review a few data points. You may note that the screen comes sorted by yield to maturity. So the highest yield to maturity is at the top. You can see the credit rating on the left-hand side. You can also see what price. So this at 94 is trading below par, and this at 102 is trading above par. You also see what the coupon rate is. This is something that pays 7.25%, and this one pays 7.125%, for example. And the minimum order quantity, don't forget that. If you have 10,000 to spend, don't pick something where the minimum order quantity is more than 10,000. And once you click one of those bonds and say, okay, let me give that a whirl, you are presented with a bond purchase screen where a random number is picked as, well, how about you throw that much money, and you can adjust it up or down. You can go all the way down to the minimum. And a few things to review on the screen: the yield to maturity right over there, the price is shown here, the coupon you can see on the screen, the par value, which is what you're going to get back, and the credit rating. As you can see here, the quoted price is $91, and even though the coupon is only 4%, because you're buying it at a significant discount, your yield to maturity is 5% because you get a par value of 100 and you only pay 91 for it. That is the concept behind it. And you're going to see a bunch of disclosures, which we talked about the bond prospectus. If you do not recollect that, you should go back and review the previous part of this same episode. And at this point, you are ready to buy. You can review the markups. You can see again that you are shown one more time what the credit rating is. And here it is. It says you're going to spend 22 grand and get 25 grand at the end of 10 years, and we'll pay you a coupon of 4% along the way. That is generally what that is saying. And with all of that said, we're going to kind of go to the wrap up here and summarize what we learned. Researching corporate bonds takes a lot more effort than municipal bonds. Public sources such as Edgar can be used. You need to read the prospectus for sure, or get a good idea of it on corporate bonds. I would suggest that you, whether you're buying a bond or an equity, truly understand the company, the industry, the threats, the competition, and so on. And don't just look at a coupon value or yield to maturity and say, there you go, let me buy that. That would not be a yield nerd thing to do. And if you have any questions, if you have any comments, feel free to contact me. Thank you for coming with me on this ride. We have a playlist. There is much more to come, and I look forward to hearing from you. Have a lovely day. Thank you for listening to Yield Nerd, a do-it-yourself show for yield accumulation and management.